Thank you so much, Anil, for that very, very impressive welcome address. Uh, you have laid out the overall landscape and created the whole contours of what the audience can look forward to over the next 2 days in a very, very succinct and a very, very elaborate manner at the same time. So, extremely impressive address by Anil, and thank you so much for that. With that, we come to the first topic of the session for the day, the new paradigm of Indian private equity focusing on buyouts. This will be addressed by Amol Jain, yes, and I will let Namit take over uh, the topic from here on. Just before that, a slight brief intro of Namit. Namit Arora, chartered holder, a fellow chartered holder, himself a very, very reasonable veteran in the private equity space, is currently a managing partner of Ind Growth Capital, a cat-free AIF, managing uh, long-only money for Indian investors. Uh, Namit was alternative investment fund focused on listed Indian equities. Currently, he is focusing on that. In his overall career, he has a 25 years of experience, which includes 20 years in private equity, as I mentioned, a very, very seasoned veteran in private equity space himself, and has been doing pipes as well. And for the last 5 years, he has been managing his own money. Prior to that, he has also been doing equity research for 5 years and corporate finance functions. He has worked with Standard Chartered PE, Bank of America PE, and ICICI Securities as an analyst long, long time back. He has also served as Vice President and Director of IAIP, the CFA Society of India. So with that, I hand over the proceedings to Namit. So Namit, the screen is all yours.
Good evening, everyone. Whoever's dialed in from India and around the world, thank you for taking the time to join us today for this conference. It is my proud pleasure to introduce our speaker for today, the opening session of this conference. We at the CFA Society India are privileged and pleased to host Amol Jain. Amol is a veteran of the investment management business in India. He has over 25 years of experience. Currently, he's a co-founder and partner at Output Capital, a mid-market buyout firm that he founded in 2014-15. Prior to starting Output, Amol was managing director at TPG Capital, previously known as Texas Pacific Group. He was at TPG for almost a decade, and he was instrumental in building the franchise for TPG in India. Prior to TPG, Amol used to head up the financial sponsors group at DSP Merrill Lynch. And prior to DSP Merrill Lynch, he started his career focusing on financial services at an infrastructure focused firm. Amol is a BTech from IIT Mumbai, and he's an MBA from IIM Ahmedabad. In his long and illustrious career, Amol has served on multiple boards as a director. Currently, he serves as a director on the boards of SBFC, Small Business FinCredit, and Senvion. Previously, Amol has served on the boards of various companies, including TPG Wholesale, which housed the Vishal retail business, and several Shriram Group companies, including Shriram Holdings, the holding company for Shriram Transport, as well as Shriram Equipment. With that, it's my pleasure to welcome Amol. Amol, thank you for taking the time, and over to you. Thank you very much.
Namit, thank you for inviting me, and a good evening to all of you. Thank you for the introduction. So, folks, the thought over here is to give you a sense of what is happening in the world of buyouts in India. It is a new paradigm which we are seeing where we are the Indian private equity industry is moving away from just being a pure minority growth equity investment business to being more a traditional private equity business as is known globally, which is focused on buyouts. So the plan is to start with a very short presentation of some 8 or 10 slides, just to give you some trends over here, both global and in India. And then we will have a Q&A with Namit, and also then open the session for a broader Q&A to the group. So with that, I'll just start the presentation on buyouts. Now, if you look at this slide over here, this talks about the AUM within alternative assets globally. And when you look at the extreme left, that is the buyout industry or buyout AUM in $1 billion. So it's about $1.8 trillion. And against that, what is traditionally the minority growth investing business, that is about $600 billion in AUM. So in terms of asset class, buyouts is the by far the largest asset class within alternatives. And the traditional minority private equity, as we see in India, is about a third of that size. So definitely the world is, the way private equity is seen globally or it operates globally is very different from the way we see this. And there are some good reasons why this has been happening, and why has capital, it's not just that capital immediately floats to a segment which has to deliver returns also. And when you look at the returns of the various funds, and obviously the top quartile funds have done very well versus S&P and the MSCI Europe, but even the average funds over there in the buyout segment have done quite well and created a delta between the overall market and the fund performance. So there is a consistent outperformance versus markets, and that is why money has actually flown towards this asset class. Uh, if you look at the trends in terms of buyout deal value, what we are seeing is that the growth, if you see on the right side of the chart, overall growth is about 5%, but certain markets, Asia especially, is growing quite rapidly. And that happens as over time, the industry, the private equity industry starts maturing and starts becoming more comfortable acquiring a business, owning a business, operating a business. I think that's when, instead of just providing capital to founders, they start becoming owners of businesses. And that trend has been obviously seen in the world in the mature markets, be it US or Europe, and Japan, Australia. And we are seeing that trend expand quite rapidly here in Asia also, including in China and in India. Uh, I'll spend a couple of minutes on this slide. I think there is a general belief that buyout market has not developed in India because Indian founders do not sell businesses. They have no reason to sell, and therefore the fact that Indian private equity industry has not done buyouts is because there's no market available for buyouts. I think that's the common perception that most people have. However, what they fail to look at is the overall M&A market. When you look at the overall M&A market, which is where the true change of control happens, that is a reasonably sized industry in India. It's about an average of $50 billion. And even in 2020, if you look at it, where there was so much of a disruption due to the pandemic, you have a total M&A volume of around $40-50 billion. And that translates to about 2% of GDP, which is not a small number. So definitely there is a change of control market available. Founders are selling businesses for good reasons. And why do founders sell businesses in the world versus in India? There's some trends which are very common. As you're well aware, the Indian businesses are mostly owned by private entrepreneurs. The government participation is fairly limited in Indian corporates. So what we're seeing is a lot of trades come because of succession issues, where either children are not present, a succession is not present. And unfortunately in India, at times, girls are not seen as a part of the succession planning. It's unfortunate, but that is definitely one of the reasons. Second, the kids are not interested. And third could be that the parent or the father feels or the mother feels that this person is not capable of owning the business in a more competitive environment going forward. So that's one of the key reasons for sale of business. The second reason what we are finding is a lot of family dispute driven business sales. And typically this will happen when there is a second and a third generation. So uncles and nephews are in the same company. They start stepping on each other's toes, family squabbles, and that is when they decide that, look, let's kind of sell the business and distribute the cash. There could be shareholder leverage reasons, both at the operating entity or at the promoter entity. And we have seen numerous examples of companies where the founders took leverage. Okay, the history is that if you see in India, India is a growing market. So when companies grow, they actually consume cash. Unlike say ex-growth businesses in US and Europe where they throw cash up to the shareholder. So typically what we have seen in many groups is that they will have a primary business which is growing well and that consumes capital. So the dividend flow is, if you see as a percentage of market cap in India, it's between 1 or 2%. So it doesn't really throw a lot of cash to the founders. What do the founders do when they want to start another business? They will take some holding company leverage and spawn a company using that equity, using that leverage as equity into the new business venture. And I'm sure that you as CFAs would always agree that short-term debt versus long-term equity, that too in a startup business, is not a great idea. And as a consequence, a number of these family-owned businesses, which have kind of recapped in some sense the value of the principal business and invested that into new businesses. I think a lot of businesses are getting sold because of the change in the IBC, the changes in SEBI laws, etc., etc. So capital for debt refinancing has become a little in short supply from both NBFCs and mutual funds, credit funds. So some of these assets are coming up for sale because of shareholder-led disputes or shareholder leverage-led reasons. Uh, Company distress is obviously, after IBC, banks have got teeth. They have started exercising that teeth, and a lot of names which we never thought would get sold are getting sold, or founders are saying that we need to deleverage our balance sheets, and they're selling their assets. So the IBC has definitely created a bit of a bump upwards, and I would say this will remain in perpetuity. It's not a one-time stock problem. I think businesses go through their own cycles, and the fact is that now banks have teeth, and they are exercising that teeth, and therefore businesses are getting sold. What we don't find a lot of in India is the in-market consolidation, because I think the whole question of build versus buy comes in people's mind that in a growing market, typically the incumbents would prefer to build unless there is some kind of franchise value, but usually it's in the more mature markets that you will see synergies being extremely exaggerated when you do an in-market consolidation. But in a growing industry, I think the incumbents prefer to build versus pay franchise value. So in-market consolidation is typically not a big phenomena that we have seen in India on the broader M&A market. And then non-core business sale. It's practically, I think every business seems strategic for Indian groups. So a business which they call non-core is actually an underperforming business. So there is no real strategic portfolio reallocation. Again, it's to do with the stage of our economy that we are in a growing economy. It is expanding. So every business house is seeding its, I would say, seeds into different new emerging geography, new emerging market segments, and hoping that some of these will bear fruit. And they will only sell one which is not performing to their expectations. But otherwise, currently we don't find that people say this is a well-performing but maybe non-strategic asset. Let me sell this and let me do something else. Yes, there are portfolio reallocations, for example, by pharma companies where they're selling certain brands and reallocating that capital released into some of their other businesses. But it is still not as exaggerated or as common as we find in the Western world. So there is some ways to go over there, but that is the nature of the economy, that in a growing market, you will probably not see some of this happening. But suffice to say that the reason why India is not a buyout market is not because companies are not getting sold. There are companies which are getting sold across sectors, and these are good names: pharma, financial services, industrials, consumer, you name it. There are businesses getting sold across the board. So good names, it's not just bad companies which are getting sold, because succession can hit a good company. A family dispute can hit a good company. There are, I won't take names, but there are very high quality businesses which have been sold because the promoters took leverage. The core business was very solid and that had to be sold. So not for a moment imagine that M&A happens because there's a bad business getting sold. M&A also happens because there are good reasons, which are shareholder specific reasons why those are getting sold. So much so for a M&A, background to the business, that just to make the point that there is a market opportunity available for buyout funds. Now, why is it that Indian private equity does not have a very big share of this M&A volume? Probably a couple of $1 billion of M&A happens or buyouts happen by private equity. There are a few reasons for that. Number one, if you look at the cast of characters which have a buyout heritage, to start with, these are the global private equity funds because they have done buyouts globally. They understand what the buyout mentality is, what does it take to create buyouts, and drive value in a buyout. Most of these are investing out of large global funds, typically say 10 to $20 billion AUM funds. And as a consequence, they typically would tend to focus on larger transactions. So enterprise value, 3, 4, 500 million dollars plus, which makes it meaningful for them to pursue these transactions. Now, two things. Obviously, India is still not as big a market. What would be called mid market in the US is actually large cap in India from that perspective. And consequently, the number of opportunities available for big buyouts are fewer in number. And the second is that in these larger transactions, what we find is there is reasonable strategic competition also from especially global strategics who tend to have a lower cost of capital than say a private equity fund. Globally, private equity competes against strategics by using leverage quite aggressively, and that is one of the tools to reduce their cost of capital. Unfortunately, in India, that is not a feasible from a regulatory perspective, but more importantly, from a business perspective. Why do you say that? The reason is, if I look at a US buyout, they're typically somewhere in the good old days, it could be even 70% levered and 30% of the capital structure could be equity. Now, that's because these are low growth companies, they throw up cash and you start deleveraging the business. Now, compare that to an Indian company where if you're growing at, let's say, revenues at 15 odd percent, and there's no change in your return on capital metrics, this means that your cash consumption is growing at 15%. And if your ROI is post-tax ROIC, post-tax ROIC is not higher than 15%, you will start consuming capital. You're not throwing capital out. So consequently, in Indian buyouts, you will find that the leverage capacity or leverage stack in the stack, debt stack, is typically low, except maybe a few cases where in IT services, which are extremely cash flow generating businesses where people have taken slightly higher leverage. But barring that, you find that leverage is not that big a component in the Indian buyout. So consequently, private equity funds struggle to compete on cost of capital with a strategic in India. And also number of opportunities available in large cap segment is fewer. So that kind of makes it difficult for the larger global private equity funds who are probably best placed to execute on buyouts. They have a smaller space and a more competitive space to operate in, which is the larger buyout segment. Then you look at the mid-market buyout segment, let's say deal sizes of 75 to $200 million or somewhere in that zone. Typically, you will find that global strategics are not interested in these companies. Domestic strategics with the ability to cash finance buyout are few. So who should be the natural buyers of these businesses? It should be private equity funds. And globally, mid-market buyout funds, there's a whole multitude of them, and they participate very aggressively and have a high share of that buyout segment. In India, what you find is that currently the industry, at least as it has evolved, has been focused on minority trades, the domestic private equity funds. And consequently, they're still making, I would say, the transition from being minority investors to control investments. And it's not an easy leap. There is a huge change in mindset that you need to bring about in terms of being able to own a company where the buck stops with you. I think that's super important to understand that you are not going to a board meeting once a quarter giving some thoughts to the founder. And if there's any problem in a factory or some inspector shows up at your stores, the buck finally stops with you. So that's one big issue. You should be able to attract the very best management talent. You should have access to leverage. And I'll talk about all of those points. So there is a transition which is happening. a select few funds may make that transition. A lot will still continue to remain in the minority space. So to paraphrase, I would say what I was trying to communicate is that there is a large buyout market opportunity available, which is the M&A market, 50, 60, $70 billion and growing. Private equity has a small share in that because the large cap buyout funds, the global buyout funds, operate in a slightly, I would say, rarefied space, which is also slightly more competitive. And the big bulge, which is in the middle, which is the mid cap buyouts, their opportunities are more, but the number of funds which participate today are fewer. We believe that this segment is the one which will start growing over time as more private equity funds start participating over here. Uh, I think this was mentioned earlier also that over time, what we are finding is that the number of buyouts in the industry is increasing. It's still a small part, so it's 4:1 in terms of value for minority versus buyouts. While, as I said earlier, that it is actually inverse, which is buyouts are 3 times the shape of the size of the minority segment. So India is still a long, long, long way away from becoming a buyout industry, but it is evolving. And this trend is a secular trend. I don't see any hurdles to an increase in the share of buyouts as a percentage of the total private equity industry. I think it's only a matter of time where we will go the way of China, where we will go the way of US and Europe. I think that's going to happen. And a lot of that most probably will be driven by mid-market buyouts, but it's quite possible that the large cap buyout segment will also evolve and have a greater share of the large, as in the global buyout funds will also start taking a larger share of the large cap buyouts. Why are buyouts generally seen to be a reasonably attractive space? I don't think so. I want to compare this with minority because both have virtues. This was in a different context, but let me just put it as some pointers to why buyouts have traditionally made money. One is that what we find is that if you buy a mid-market family-owned company, the quality of management talent available over there tends to be a bit, I would say, not the very best, and you can upgrade that. Second area which we find as an area of opportunity is a sharper strategy in these companies. So what you find is a mid-market family-owned company was started maybe 20, 30 years back, where the founder saw a white space in the market opportunity. He built a business, and then he has now started doing a bit of a strategy drift by going into adjacencies, which may or may not be the most natural adjacency, or even a pure play diversification. Because sometimes and I'm not generalizing this point, so don't take me wrong, but sometimes when you do not have great quality sounding boards in terms of the people on your board, and you are the only person who has to take all decisions, and decisions tend to be taken by gut, which is not a bad thing always, but some degree of, I would say, pushback by the board, some degree of uh, measuring or testing these against data or logic would help in reducing these strategy drifts. And we find that when you knock down these various business units, a bunch of them don't make a reasonable return on capital. And there is value to be created by creating a very sharply focused company. And then I would say operational excellence is something we find is I would say, an outcome of the management upgrade, because execution capabilities are better with a better quality management team. Uh, then the other traditional issues which we find in minority private equity, which are corporate governance failures, which you tend to see once in a while. I think that gets restricted substantially in control investment. And when I say control, I mean board and management control. And then there is elements of capital structure optimization. But the one I would like to point out about is the exits. This is an important point. Now, you are all investors or learning to be investors. When you look at the Indian IPO market and see it over 10 years, I think the average Indian IPO market is somewhere in the $3 to $4 billion range per annum. And for a $2.5 trillion economy, it is next to nothing. Now, put that in the context of approximately $15 to $20 billion of private equity going into the country every year. Now, assuming that all of them want to make at least 2 times their money, so that's $40 billion of private equity capital seeking an exit, assuming it's 100% secondary only. There's no primary capital raise, etc., etc. So on a rolling basis, you have a very small window. It's almost like the eye of a needle of $4 billion, and then you have $40 billion trying to exit. Even if you say, okay, fine, they will do a part exit, but still the size of the window versus the size of the capital seeking exit is just completely mismatched. And the other issue is the IPO market is highly volatile. 1 year it opens up, and after that it goes to sleep for 18 months. So that's a very, very strange thing, that your company has to be ready, the market has to be ready, and you have to be ready at the same time to get an exit, which is why this whole problem of exits in minority investing. Compared to that, in control investing, you take the decision as the owner of the company, and your exit opportunity is actually in the M&A market. And if you look at, I'll just flip a couple of slides back. If you look at the M&A market, it's a $50 billion opportunity. So that's a 10 times bigger market, and the volatility is much lower. It is not a market which goes up and down at the whims and fancy of some short-term investor. It is a market which sustains itself, because when a buyer wants to buy an asset, he's not saying that, look, I'll wait for 12 months and see how the market goes. They know that this asset is on sale now, and otherwise, if I don't participate now, it will go to somebody else. So it is a less volatile market also from an exit perspective, and you control the decision to exit, which is why you will find when you look at the data that the liquidity risk is a lot lower in buyouts. The area where you fail to find an exit is typically in a bad business. That becomes a real challenge in control investing, because in minority investing, if it's a bad business, it gets listed at some hot market, you can dribble down your 5 to 10% stake to somebody at some value. But in a control deal, if you have a bad business which nobody wants to buy, you can get stuck with a lemon. So that's the one thing that you should be aware of when you're buying a business. But otherwise, if you have a reasonably good quality business, control is always liquid at some price. As it largely the key enablers are, and this is, I would say, a secular trend, that the industry is maturing. People are getting more and more comfortable with company ownership rather than banking on a founder to deliver the goods to them. They're happy being the controlling owners of companies and saying that we will take the ups and downs of the business. That's, I would say, just attributable to the maturity of the industry and the quality of talent which is coming in, which has probably had some exposure to buyouts, and that breed is increasing. So I would say that this is a one-way road. High quality management talent is available from the larger Indian corporates and from MNCs, and they are all happy. People in their late 40s, early 50s are more than happy to jump ship, come in and join as quasi entrepreneurs in a private equity owned company, and for good reasons, be it entrepreneurship, legacy, and wealth creation. So we find that in our transactions, we have access to the very best management talent, which may or may not be visible on an average to somebody who's just trying to headhunt for a mid-market family-owned company. Access to leverage is opening up, has opened up. NBFCs are there, banks are there. I think there's some easing of the market and regulatory conditions, etc. And overall, I would say the regulatory environment is becoming a lot more transparent, and therefore ability of a private equity fund, which typically will work with under either a UK bribery or an FCPA or whatever not, I think that becomes a lot easier. You're not dependent on your ability to manage the environment. You can actually run an honest business. I think over the years, the government has taken several steps to improve the operating environment, and private equity feels comfortable that they can operate under the global governance norms within the Indian context. So that itself is a big opportunity. There may be still some sectors where you may have to deal with externalities, wherefore in infrastructure, for example, private equity plays a smaller role. Those could be good reasons, but generally speaking, I would say India has now become a place where people feel comfortable owning these businesses. With that, I will stop the presentation, and maybe, yeah.
Sure. So thank you, Amol, for a very detailed presentation and sharing your thoughts. We have a few questions coming in, but before we get to that, a couple of questions from my side. One is around leverage. Since I'm picking up from your last slide, we understand the constraints of domestic leverage, but do you see opportunities for some global funds to take leverage offshore? And we've heard of some mid-cap IT transactions, etc.
Yeah.
The reason I ask that is that given that threshold returns is a consideration, do you see that sort of option being available to funds and that also driving deal flow, even though domestic leverage is constrained?
No, absolutely. I think, Namit, there is a whole bunch of IT transactions, especially, which have happened where folks have taken offshore leverage. And as I was mentioning, that the cash flow profile of these companies is so rich
Mm.
that they are able to throw up the cash flows to service their debt. And on generally speaking, I would say the leverage available offshore is long dated and a bullet loan. So all you have to do is service the interest in the middle, which is fairly doable for the funds. I think the one thing which we may come across is that AIFs may struggle a bit to create these kind of holding company structures because they have to operate out of the Indian context. But that's besides the point. But yes, offshore leverage is an integral element for the global buyout funds where they are not able to do a recap of the existing opportunities. And I guess today, with the change in law, now the slump sale structure, the advantages of that slump sale structure in terms of the tax breaks have gone away. So to that extent, that's a little bit of a challenge. So I would say on a average day, opco leverage tends to be a bit limited. But I would also highlight one thing, Namit, that if you were to leave aside the IT services transactions, which have historically happened in the 8-9 times EBITDA range, and let's say you're putting 3-4 turns of leverage, if you look at, say, a consumer buyout in India and you're buying it at 12-13 times, okay, and you put 2 or 3 turns of opco leverage, because people will not go beyond 2-3 turns of opco leverage, you are still talking of 25% of the gap in debt. 75% is still equity. So these are equity heavy buyouts. Whether your leverage is 3 turns or 2.5 turns, the returns honestly do not vary dramatically. So when we think of buyouts and returns from buyouts, leverage is cherry on top, but it is not the driving factor, except, for example, in segments like IT services.
Got it. There is that's very helpful. There's an interesting question around exits, and I think you gave a very stark example of 4 billion sort of IPO versus 40 billion sort of money looking to get out. While SPACs are fairly recent, and Grab is trying to do a SPAC, and that is one. And second is there is some attempt at liberalizing the Indian companies to be able to list directly in offshore markets. So there's a question from the audience about saying that do you foresee that over time SPACs and listings in international markets could offer additional avenues, and that could accelerate the volume of buyouts and generally PE in India?
Okay, let me try and take a stab at a response over here. I started out as a banker many, many years back. And in those days, first we started with GDRs and then ADRs. But I now don't recall when was the last GDR, ADR done. The reason is that eventually what folks found was that most of the funds are already in India. And B, if you are not of a certain scale, you don't get traded well. I think a lot of companies did these AIM listings also. And generally, these were seen as the poor quality governance companies which went for AIM listing, but forget that part. But all of them figured out that it's not a great idea to be only traded stocks somewhere else. And therefore, they came back to India. And India has been the primary, I would say, location for IPOs in India for Indian companies. So you got to have a business model which is very attractive. For example, some of these digital or consumer tech businesses or SaaS businesses may find a home in a NASDAQ or wherever else. Bulk of traditional Indian businesses which are well understood by an analyst in India, because if you think about it, you're getting covered by somebody sitting in a New York exchange on the Wall Street. It's like one of us trying to research a company in Philippines. That context just does not get done, and consequently our view, and also if you think about in SPACs, some of the recent SPACs which have been conducted, typically the liquidity offered to the selling shareholders is usually 15 or 20% of their ownership. They continue to be 70-80% owners of the entity over there. So their full exit, it's almost like an IPO where you get a 15-20% exit, and now you got to figure out your residual 70-80% and how do you sell it down.
Hmm.
Now, obviously, this restrictions on promoter ownership of 20% or whatever controls that we have in India, I think those go away. But it's not as though the SPAC is a exit of 100%
Hmm.
you. So there's a lot which you still have to exit, and that will depend on whether you are well covered, well traded, or not. So look, I'm not denying the fact that if more avenues of exit open, it's a bad thing. I think it's always a good thing. Having more options, optionality always helps. But it has to be seen in the
Hmm.
context of what it means to the controlling shareholder. But it will definitely add to the arsenal of what you can do to exit your business. And I think SEBI is also doing some effort around SPACs. So if SPACs become common in India, it becomes an easier way to list. I think those things will happen. But it's a good move. But it's not going to be an earth-shattering change immediately.
Got it. Very helpful, Amol. There's an interesting question, and I will tie into your slide. You had a very interesting slide 8 on multiple levers in buyouts,
Yeah.
where you were not intending to compare buyouts versus minority. So taking it in isolation, you had 5 factors there, and one of the factors in those 5 was corporate governance failure, partner issues. So the question is specifically come without getting into the specific transaction. The question is about what the audience is trying to understand is what have been some of the lessons from some challenging buyouts in India, some failed buyouts, or where there were surprises post buyout. And if you could tie that in with your experiences in general about diligence, that while post transaction you would have full control, in spite of all the diligence, could there still be surprises? And even though you have full control post transaction, it might make value creation a little challenging.
Oh, yeah, obviously. So look, I think I would break that question into two big buckets. Why have buyouts? What are the lessons to be learned from buyouts which have not done as well? We obviously, if we are trying to practice the trade, we also try to look at the learnings from all of these transactions. And I would say instead of corporate governance, the biggest reason for the underperformance of buyouts in India has been where funds like ourselves have gone in and acquired smaller businesses. So we did some analysis which suggested that if you cut the Indian buyouts by deals below 100 million and deals above 100 million, the success rate of deals above 100 million is somewhere around 75 to 80%, while success rate of deals below 100 million is somewhere around 20-25%. So it's statistically, it is reasonably remarkable that the size criteria defines a lot in terms of whether a buyout is successful or not. Now we then went through some of these transactions which have not done well to understand what happened and what went wrong. Typically, the biggest reason is as follows: that these were investments done in companies which operated in emerging sectors where the sector dynamics changed over time. Okay, be it in aviation, be it in insurance, be it in other spaces also, or they got done in emerging in mature sectors where you had a play of a contender who was coming in and challenging the incumbent, so a challenger. And what you thought was something that you had as in your arsenal to beat the incumbents, that did not play out, and those transactions failed. So I would say that if you look at it globally also, and you look at the websites of global private equity funds, they will say we buy businesses which have a long track record of delivering reasonable returns. So they're not taking business model risk, in an emerging sector or an emerging company, because that risk is best, I would say, assumed by an entrepreneur. Private equity's role is to come in at a stage where the business model has been reasonably established, and then you scale up the company, plus you drive operating efficiencies in that company. And when I say operating efficiencies, I don't mean only by cost. There could be multiple other ways of driving operating efficiencies, your price realization, your gross margin, so all of those things. But private equity, what we at least found in the Indian context is that doing a smaller buyout tends to underperform because of business model risk, where something went wrong in the business model. Uh, Corporate governance failures do happen, but that is, I would say, one is, as you rightly pointed out, at the time of entry. Before entry, did you do your diligence properly or not? There are two things one would argue. That one is that diligence, that quality has to remain the same in both buyouts as well as in minority. That risk does not change. But one thing that we do try to figure out when we are trying to buy a company is the reason to sell. If there is a 35, 40-year-old guy who has run a company for 5, 6 years and he comes to you that I want to sell the company, the red flag goes up and we think 10 times before we say whether he's doing this for a genuine reason. So reason to sell is an important indicator to figure out before you understand, if there's a good reason, the company has been around for long enough. And at some level, the onus is on us also as investors, that we are all in the market, we are all in the environment. I think I would say that there is a smell test, and you pick up a few phone calls. You tend to 9 out of 10 times, unless someone is a very, very high quality rogue, you tend to pick up these smells.
Got it. Amol, there are a couple of questions around exits. So one is entry to exit. What's the sort of time frame you look at, and is it different for a buyout transaction? Going in, how do you think about timeline? And I'm cognizant it's a function of markets as well, but given that M&A is a preferred or a likely exit option for you. And secondly, a related question is, from an India standpoint, do you think some sectors are more amenable or attractive to buyout funds?
Okay, so I'll take the first one. That in terms of the timelines, typically I would say that time is the enemy of IRR. I think we all appreciate that. So sooner sold is better, but what you don't want to do is sell too early. So the way we see it is that a lot of the efforts that we put into the company in terms of the dramatic change that we want to bring about in a company gets done in somewhere in the 18 to 30-month phenomena. So operating changes, bringing in a new management team, driving the business in terms of revenue trajectory and the operating efficiencies, that kind of gets visible. It may not be fully fructified, but when you are trying to exit, you can at least show a clear trend line to the incoming buyer that, look, this is the future of the business. So if you were to ask most people, apart from the lucky early flips that some of our peers have had, typically they will say that we start planning our exit in the 4th year. Now, somewhere in the 4th or the 5th year is when people think about exiting, because history has been established, track record has been established, and you then the future can be discounted by the incoming buyer reasonably easily. There's no real big, I'm saying X and you're saying Y. That does not happen, at least in most parts. So that's the normal phenomena. You will also see that deals which do not get sold are usually the bad deals. So there is a selection bias when you look at data and they say, oh, the average life of deals exited is 4 years. It's usually the good deals which get exited in 4 years. The ones which are not exited are the ones which will linger on for a while longer. So that's true of both minority private equity as well as control, but minority may have that added disadvantage of markets. But regardless, I would say 4 to 5 years is the zone for good buyout trades.
Got it. Thanks. The other question is around, the core skill sets.
Yeah.
We at CFA have a huge focus on career planning and career guidance. So the audience is interested in what are the core skill sets of a buyout fund manager. And secondly, a younger person has asked, what's the career path for an entry-level analyst to being a fund manager, and some color around traits, characteristics, etc.
A hard question to answer, but I will try. Look, if you see a few things which is common for most investing is that, okay, let me give a long answer to this question. That in my previous firm, the firm had done an analysis of what makes for a successful buyout. And they looked at a lot of deals that the firm had done over 20 years. And they came to a few very simple points, which are not, I would say, eureka moments, but simple things that the successful deals had the following traits. They were in a good industry where the industry structure was such that reasonable number of market participants were generating a good return on capital. So the first point being what Mr. Buffett says, a good industry. Second, the company, even if it's in a good industry like consumer businesses, it should not be strategically compromised. It should not be uncompetitive. So that was the second point. Third point was quality of incumbent management stroke the management team that we brought in. The fourth was price, and the fifth was operating value add. So that was the trajectory. Now, if you think about it and you're talking about skill sets, a large part of the skill set is basically identifying what is a good business. So that is the be all and end all. People sometimes tend to focus on deal making, that look, I was able to source, I have relationships. That is, at times you will find that, look, globally buyouts happen through auctions mostly. And even in India, when somebody is selling a business, he will do market price discovery. You can keep claiming that I have an angle and I have a proprietary deal. No, everyone seeks market price discovery. Full auction, broken auction, imperfect auction, but people do that. So sourcing is not the pure skill set, but first skill set is to identify good businesses from a long-term perspective, because you're going to be owners of businesses. I think that is one fundamental shift. If you're thinking from a life of being a market participant to being an owner, just think of every business as an owner would think, that do I want to own this business for 10 years, 15 years or not? Even though you will exit after 5 years, but you have to give a future of another 5 years to the incoming buyer. So identifying a good business is the first thing. Second is people skills, which I think is true, may not be as true in minority, as in public market investing, but in control investing is important, both from a buyer seller relationship management, which is deal making, and also your ability to build a relationship with your management teams, be on the board of these companies, influence your management teams. Because look, we are not operators. So we have to work through the management teams, but we have to have the credibility with our management teams to say that, look, these are the things that we can contribute, and operations is something that you do. But you have to earn their confidence and their respect with what you bring on the table. So it's again an intellectual effort. The third would be hard work. I think it is intense hard work. It is, because you have to go into a lot of detail. When we invest, we look at HR, we look at IT, we look at apart from the commercials of the business, you will do a, sales and marketing analysis, manufacturing analysis. So again, I'm repeating myself that you have to see buyout investing is that you're becoming an owner of the business. If there is some FCPA issue, or there is some worker payment issues that they're not being paid minimum wages and you sit on the board, you will go to jail. So all these efforts have to be done by you. So it's a lot of detail. It is big picture in terms of good business, but it is also a lot of insane amount of nitty gritty detail. You sit on an NRC, you have to decide on bonuses, you have to decide on stock option plans, you sit on an audit committee. And I was a minority investor. My participation in an audit committee as a minority investor is very different versus what I am on the board as a control investor. So it's a lot of detail, it's a lot of engagement, it's effort. So identifying good businesses, being good with people, learning structuring skills, which I think as a CFA you would have all of those. Accounting is important in buyouts. How does some sale make life better or worse for you? Structuring of transactions which makes sense and create some delta for you and for the seller. Knowledge of regulations, SEBI regulations, if you're doing public market M&A, is super critical, because there is so much to be learned over there, and there are so many angles which you can create when you do proper structuring of deals. So tax and regulatory and accounting is an important element of what we do. But then the big part is what we do as a business and what we do with it through the management team.
Thank you, Amol, for a very detailed perspective. Very helpful. There are a couple of interesting questions. As you can imagine, given the focus on startups right now. So the audience wants to know: do you see buyout funds having an appetite for the digital, new age companies, the digital ecosystem? Do they have the appetite to actually come in, buy, or do a roll-ups here, or buy off these sort of businesses and burn cash for a few years? Or will they look? I mean, it's frankly a very a question I didn't anticipate, but given that it's come through, would love to get your color on it.
Sure. We have not seen buyouts of EBITDA negative businesses generally. I think people have taken equity stakes. If you see uh, private equity participation as of now in digital businesses which are EBITDA negative has been fairly restricted. Traditional PE funds struggle a bit because we are not used to hyper growth and cash flow negative businesses. And where the world is changing fast, you can't, you're trying to deploy, you're not like a VC fund which has 30, 40 portfolio companies. So even if a few blow up, that's okay. So just from the business model perspective, if you have a fund and you want to do 10 odd deals in the fund as a PE fund, even if one goes south completely, I think that is something which a PE fund struggles with. So it'll these kind of companies will get bought when they are lower down in the risk spectrum versus where they might be today. So I think once say profitability is well established or business model is well established and profitability is visible in the near future, I think that's when you might see it. But I would say that it's all about where does private equity play in the risk spectrum by virtue of the fact that they do not have a highly diversified fund. They will tend to, a buyout fund will not have more than 8 or 10 deals, at least in the Indian context, in its portfolio. So you can't have too many of these blowing in your portfolio. So I would argue that there is some way to go before PE funds start buying businesses. I would say don't think of it as digital businesses or XYZ businesses. It's about whether the business has reached a point where the risk has been mitigated substantially. But there will definitely be a time because a lot of these companies are owned substantially by venture capital funds. The founder stakes are quite low. So there are deals which happen where somebody comes and cleans up the equity stack. But many of these businesses will directly find a home on the capital markets and their valuations can be very, very rich over there. So that phenomena will also happen as a competition to buyout funds.
Okay, got it. There's another question which you are uniquely positioned to answer. The audience is interested in the supply side issue in terms of obviously the bulge bracket firms are there and you have most of them in India already. The question is, do you see a domestic PE fund or an Indian franchise, a lot of them becoming serious buyout players going forward? And given that you built the franchise at TPG for a decade, and now you're building out the franchise at Upward for the last 6-7 years, would be useful to get your perspective on it.
Look, I would say definitely a yes. Not because I'm biased for that, but simply for the reason that the number of deals available in the mid market is a lot. If you just look at the number of companies, there are something like 3,000-4,000 companies or maybe more. And second is that competitive intensity is limited. As we discussed earlier, inbound from somebody in US or Europe trying to buy out $100 million company does not happen on a given day usually. Uh, Domestic strategic buyers do not have that kind of capital to do a cash financed buyout. And I'll give you an example. We ran a small analysis to say that, looking at the listed companies, how many listed companies, as of say, we did this analysis on FY20 financials, that how many companies, and these are listed companies. So if they did an acquisition of $200 million post acquisition, how many such companies are there who can do a cash acquisition and their post acquisition debt to EBITDA is less than 2.5 times? The number was only 85. So a 1,500 crore acquisition. Post that, what is your debt to EBITDA? in a listed company, typically people will say 2.5 is a reasonable number. Let's not go beyond that. So there is 85 companies across sectors. Then you say that, look, a Reliance may or may not want to do a $100-200 million buyout. So companies for whom a $200 million buyout is not even 10% of their market cap, you ignore those because these are then become too small for them. So if you remove companies which have a market cap of 2 billion plus, you're left with 45 companies. And this I'm talking of March 2020 financials. 45 companies across sectors, then you do a filter of strategic fit, you do a filter of mood in the boardroom, whether they're keen to do a trade at that point of time or not, and other ancillary reasons. We find that domestic buyers, strategic buyers, very few of them compete for mid-market buyouts. So willy-nilly, the buyout investors left in the market are the private equity funds. And eventually, that migration will happen. Not everybody has the DNA to do buyouts. There are few people who have and who are making that effort and are getting there, but a lot will remain behind. And there may be a new breed of people who do not come from I would say, a legacy of minority investing, but come from a legacy of buyout investing from big bulge private equity funds. They may come and start buyout funds over here because they feel comfortable doing buyouts. Because I'm just telling you that when you have a mindset of a minority investor, half your portfolio is minority, half your portfolio is controlled, it is a lot more effort to do control. It's a lot more rewarding, but it's also a lot more effort. So when you think of incentives of people, they say that, look, if I'm a VP or a director in a fund, I can do 2 minority trades versus 1 controlled trade. Let me do a few more of these. So I think those are things which happen, but I'm definitely sure that there is a number of companies getting sold. Limited competition for buyouts means that private equity will take a bigger and bigger share, and whether existing players take it or some new players come in and take it, yeah, could happen.
Okay, very helpful. There's a question around ESG. Your thoughts on ESG, and also, is it even more a consideration for buyout funds?
So look, ESG is an important thing, increasingly very, very important for everyone. I think if you ever take capital from anyone, either a DFI or even now no longer a DFI, but a sovereign, etc., everyone is talking about ESG as a phenomena which is important to them, and they expect you to execute on that. Now, when we think of it as a buyout investor, we feel that we are in a better position, partly because we control a company. So we can drive the ESG initiatives quite hard in our portfolio companies without there being, first you have to convince the founder and then he has to convince the manager. That train doesn't apply to us. We can go directly on the ESG front. Now, apart from saying that, look, we have to be good corporate citizens and all of those things, which on a given day somebody can take a different decision. Why do we say that ESG is good for us? Is that for a buyout investor is simple fact that when you are looking to sell the company, you're looking to ideally sell it to a MNC because they will pay you the best price. And if you have a filthy factory which is spewing effluents into the nearby farmland or river, or you are not paying your workers enough, all of those issues means that your buyer universe shrinks. So it is in our own interest from a long-term exit perspective to do a proper job of ESG and ensure that these companies comply to the very best standards, such that the buyer universe never shrinks because of ESG considerations, because increasingly corporates are also being forced to think about ESG. So that is one point. And second, I would say on an average, we do find that while ESG may add some costs initially, but longer term, I think, and we don't have a good answer to that point, but it does help in reducing some of these considerations. I'll give you an example of an MNC cement company. And I was speaking to the CFO over there, who's an ex-colleague from early days. According to her, whenever they would set up a plant, before that, they would do surveys around the place. And typically a cement plant consumes water. So they would create alternate sources of water, do rainwater harvesting and, recharging the water table, etc. Over a period of time, they've created such a great track record that when they have public hearings for acquisition of land, actually the land prices go up. So villagers are welcoming them. So because they believe that the place will be developed and it doesn't cost much. In the overall project cost of a cement plant, it's next to nothing. But you just apply your heart and your mind to it, you can actually see the benefit where you don't have any opposition to land acquisition by a cement plant. So I'm just saying that sometimes it can actually work good for your business if you do the right thing. And ESG, therefore, we believe is it's not just for the sake of ESG. There may be some elements which could be just bureaucracy. Ignore that. But if you get to the heart of ESG, proper emission norms, proper recycling of water, you don't consume more water, you take care of your workers. Look, if you are seen as an offshoot of ESG is HSE, health, safety, and environment, but health and safety, if you are seen as a owner who cares about health and safety of your workers, if ever there's an accident in your plant, I think the retribution against you is going to be a lot lower because you would have done what it takes to ensure that these occurrences don't happen, and it could be a genuine mistake. But if you are seeing a plant where pipes are leaking and there is smoke all around and some accident happens, I bet workers will be disturbed with you, your regulators will be disturbed with you. So there's a reputation that you create, FCPA reputation. If you create a reputation that, look, guys, I'm compliant on everything, I'm not going to get squeezed. Over time, I think the inspectors also let you be and say, okay, fine, maybe I'll go down the street and squeeze somebody else. These guys are compliant, and most people will let you be. So I think ESG is good for business.
Got it. Very helpful. It's great to have a very engaged audience. So, Amol, there's another interesting question on take private. So the person wants to know that you have a very large number of listed companies in India. There are sort of zombie listings, or there are small caps, micro caps, which are illiquid. They may be good businesses, maybe challenge for growth. So as a buyout fund, do you think that's an asset class that is worth your time to pursue? And also, given that you talked about SEBI and IPO, etc., and the regulations, what would be your recommendations to regulators to sort of ease the pain in that asset class to make those kind of opportunities more interesting for you, given that they're already listed and they may not be your first port of call?
So yes, these take privates are a big deal in a global market, and that's an integral part of buyout investing, where people recap these businesses through the use of leverage and take privates are common. India, we have the regulatory issues of the 90% threshold. Obviously, there have been improvements in the regulation. That mean median mode concept has gone away, where people would try to kind of squeeze you by buying chunks. But even then, the 90% threshold has been not easy to get by in most companies. I don't know how many take privates have happened. Only a couple have succeeded in the recent past, I think. So I if you were to take a poll of private equity buyout investors, I don't think so anyone will hang their hat and say that we will do a large take private as a significant component of our portfolio. I don't think so. We look around for take private candidates at all.
Okay, got it. And Amol, there's another question around exit. Is that do you start thinking of exit before sort of doing your deal and exit planning? And in spite of all the sort of planning, are there possibilities that, given that this is not a minority investment, there's a chance that some buyout funds might sort of get stuck and not get exits? So just some color around that.
So look, yes, when you buy a company, you got to always think about who could be potential buyers at the exit period. So you do that scan upfront. Now life may change because again, global boards think differently at different points of time. India may or may not be a priority when you think about exiting, but on an average, you do try to say that who could be a potential buyer for this business that I'm looking to acquire, be it in India or overseas. So that's the first thing, that identification of buyers is done, and you figure out why do you have a strategic fit with them. And if there's a limited universe, then you would try and tailor your strategy and your business a bit towards that limited universe and improve your strategic fit. But I would say broadly, the way we work is we figure out the starting point of buyer universe and work towards that over the next few years. Life may change. As I said, your business may not do as well, or the buyers at that point of time when you want to exit may not be interested in India, may not have financial wherewithal, could be different reasons. So you do get stuck for exits. But if you have a good business, maybe your exit may get delayed by a year or two. You will get an exit. If you have a bad business, as I said earlier, I think you can get stuck for long. If there are no strategic
Right.
buyers who are in the same line of business to whom you mean something beyond just asset value, I think there's a high likelihood that you will get stuck. You have to think about what is the franchise value in my business and why should somebody pay me for it.
Right. Okay. Amol, two questions around the market valuation levels. Given the liquidity surge and where the public markets are, do you see deal making sort of getting more challenging? That is one question. And second question, and also that is ties in with the question around dry powder. That if there's since there's a lot of dry powder floating around, does that also make it more challenging besides the broader valuation levels? And the second question was around the fact that you talked about the 2 billion versus 40 billion. Given that the buyout deal volume will go up meaningfully over the next 5 years, do you foresee the Indian IPO markets becoming more deeper? And therefore, instead of M&A being the sole sort of as the primary option, do you see the IPO market itself becoming more deeper over time?
Sorry. So there are a bunch of questions. If you could, one is that the
Yes, yes,
valuations currently, how do they
yes,
impact deal making? Second is
right.
competition, how does it impact deal making? And the
Y-
third point around IPO markets becoming bigger, what was the implication over there? I couldn't
So
understand.
implication was that if there's $40 billion of private equity looking to exit and the IPO
Yeah,
market is only 2 billion,
yeah.
over time do you foresee that you could have greater avenues by a more vibrant IPO market?
Sure. Okay. So look, when valuations are up, even if IPO market or the capital market is not, let's say, okay, let me put this differently. There's a 70-year-old founder who's looking to sell his business. He does not have a succession plan. He needs to exit. He can try and benchmark you against the capital markets, but what you will typically find is that transactions in the mid market or M&A transactions, surprisingly today, are happening at a discount to capital market valuations. There are a bunch of companies where companies are getting traded across sectors at a discount, which is very, very odd because typically you would assume that there is a control premium which should be paid, but that doesn't seem to be happening in many cases. So unlisted companies do get sold at a discount to capital market valuations. But if there is a listed company which is well traded, at times it becomes a challenge, and there are a bunch of private equity owned companies, a bunch of, I would say, transactions also which recently had to be taken off the market because the market stock price went up ginormously. So listed company M&A does get impacted because again we have the regulations of RBI where you cannot do a trade between a resident and a non-resident at below market price. So, and obviously when the price is X, even if the founder is looking at an exit, he will like to believe that that is the fair value of his company. And so yes, a hot market impacts listed company M&A, but it may or may not as much impact unlisted company M&A because there the transaction dynamics and the discussions are around fair value. So that is one. Second, on competition, look, as the space has more and more players, today it doesn't. I think today in most transactions you will see two or three private equity funds, of which not everybody likes every deal. So we don't find it to be a very competitive space in the mid market. Uh, but over time, will it change? Definitely. There'll be more players and there'll be more competition. And the only hope is that the market is still, I would say, there is a unmet sale demand because there are more companies waiting to get sold and there is limited dry powder available or players available to buy those companies. So we think that that dynamic of demand supply mismatch will sustain for years to come. And the last point around IPO market, whether it will increase in size or not, I guess it's hard for me to answer that question. I have no idea.
Sure. Amol, given your global experience, there's a specific question about saying what would be your recommendations to the government or the regulators to make buyouts more easier in India, which could result in easier and sort of more volume of buyouts?
Look, I think for good or for bad, the slum sale kind of tax, which has that the tax break that we could have explored, which was very hotly debated point internally. I think that has gone away. So there is clarity on that. I think there is significant clarity on taxation on Mauritius, India, AIFs, etc. So I think tax has significantly eased out as a big issue, and tax planning, tax structuring is kind of becoming a lot easier in M&A trades. I'm just talking more from an M&A trade perspective, less so from a PE versus, because what ails M&A trade is what ails, I would say, private equity also in buyouts. Uh, where do we find that regulatory considerations become an issue? Sometimes we find that certain SEBI regulations and listed company M&A do tend to become challenges, and we do keep representing once in a while to SEBI, for example, around this delisting issue. And I think the PMAC and SEBI are quite conscious of these issues, and they have been taking on board some of these points. And I would say that SEBI, has to do a balancing act. It cannot be a one-way perspective from them, but they have been fairly receptive to ideas on changing regulations. I would say, and the IVCA has been doing a lot of effort with the government on AIF regulations, again to facilitate domestic private equity industry, which can focus on the buyout segments in the mid market. So I would say, are there any headline recommendations upfront to the government today that I can talk of? No, but I would say it's a continuous process. Some of the big lumps have gone away. I think, if I may argue, one thing that one can still argue for is banks' inability to lend for share acquisition. That would go a long way towards easing buyout investing in India, because today NBFCs being where they are, I think it's a challenge to receive wholesale financing from NBFCs because there are very few of them left. So I think that would be the one big area where, if banks can be allowed by RBI to finance control purchase, not capital market purchase, but a controlling stake purchase, I think that would be one big change which would assist.
Thank you, Amol. We're into the last 5 minutes now, and we have a very engaged audience. So my apologies to the audience. I may not be able to take all the questions, but just last 5 minutes, a couple of early questions I will just take. Amol, this is completely unrelated to buyouts and PE, but since it came through, I'm still asking you. People want to know your view on crypto. It's very new and very recent, but they were thinking about as an exit mechanism for PE, as a sort of way to swap your holdings, but I'll still just lob it through in case you don't have a view.
I think I will have to kind of sit in the next session after this and understand all of these issues. So I have no view at all.
Amol, I'm in the same boat, so I think both of us have to attend that and educate ourselves on crypto. Okay, the other question, Amol, is around you already mentioned cash flows. So is it fair to say that on infrastructure side with negative cash flows or etc., buyouts in infra are relatively less likely?
Okay, I think if you speak to the infra funds, they will say that they have been doing a lot of buyouts. So I think a couple of people, for example, Morgan Stanley, Edelweiss, they have moved their business model away from, I would say, development of assets to more about acquiring operating assets. I think that segment has taken off quite dramatically and is doing fine. So I think wherever a development risk, which has its own issues, as we all recognize, of land acquisition and other assorted regulatory approvals, I think so infrastructure has seen a decent volume of buyout operating assets.
Sure. And if I may add to Amol's point, for the benefit of the audience, you look at KKR, there was an operating power transmission business, IndiGrid, which was listed from the Sterlite Group. But again, there they segregated. All the operating assets were in IndiGrid, they were listed, and that has seen a change of control with KKR coming in as sponsor. So I think that did happen. Okay, and Amol, one question around any view on real estate investing, again, not related to buyouts, but since the audience wanted to know. Any view on that?
Perspective. I haven't bought a house, so I would be the last person to comment on real estate investing.
Right. Okay, thanks. And Amol, one question around distress financing. That is buyout fund typically also open to distress situations where the cash flow may have sort of gone off kilter, but you're willing to step in and do buyouts even though it appears pretty stressed to begin with.
Yeah. I think that is something which is happening, and IBC, I think IBC or pre-pack bankruptcy, which is being spoken of, or even OTSs, I think those are segments which buyout funds are participating in or looking to participate. It has not been easy. I don't think so. There are tons of examples of buyout trades, but a couple of our colleagues or peers have done a few transactions. Not so many as pure buyouts of distressed companies, but they have financed OTSs through a mix of debt and equity. But pure play distressed buyouts have not been easy. I think private equity funds are trying that, but still some time to go. For example, SSG has bought the Altico business, I think, very recently. So that could be termed as one buyout deal which has happened in distress. And DHFL was a trade in that direction, where Oaktree was competing heavily with Piramal's. So I think it's again a coming of age, but that may be done partly by distressed funds who have a little bit of, I would say, different skill set and bent of mind. Buyout funds typically will look at reasonably, operating businesses and buy them for good reasons of shareholder issues. So there may be a separate segment of funds who may look at distressed business buying.
Got it. Amol, this has been phenomenally insightful. So on behalf of the CFA Society and the entire organizing team here, my very, very sincere thanks to you. Thank you for taking out extensive time and sharing your insights so candidly and generously. And I would just leave with a request that we may have to request you to come back again in our future events, given the interest in the audience and the depth of your experience and the candor, the way you shared it. We're completely out of time. So thank you very much, Amol. Really appreciate that. And with that, I turn it over back to the organizing team. Thank you.
Very much. Thank you, Namit. Thanks for a very
Thank you, Amol. Yeah, thanks.